welcome all of you. Thank you so much for joining today's session. I'll be introducing today's topic with the help of a hypothetical situation. Let's begin. In our story, we have two characters. One is Kutusin and the other is his sister Dagini. Now you must be wondering whether they are siblings, but here we are taking them as siblings. So Kutusin is running a sole proprietorship business and it is going very well. And one day he returns from his office and he keeps his financial statements in the desk or the table, whatever it is. Dagini passes by the dining table and she sees a file of all these records and she is curious to know what is inside. So she picks up the file and sees the profit and loss statement, and she is wondered by seeing that there is a profit of 5 lakh in the profit and loss statement. So she is very happy and she thinks, maybe I can do something for myself since he is having a profit of 5 lakhs. So this lady takes his debit card, his business debit card, and goes to the jewelers. Dagini is very excited and very happy, and she goes to this jeweler and she tries all the types of ornaments there, and she finally fixes to this beautiful diamond necklace that is worth 4 lakhs. And she thinks to herself, I didn't spend all the money out, I'm just taking 4 lakhs out of 5 lakhs. Please remember, this is a hypothetical situation. Okay, so she goes to the billing desk and she gives her brother's debit card, and to her surprise, the transaction gets declined. She is wondering, I saw that there is a profit of 5 lakh, and Kutusin had told me last day that he keeps all of his money in his business account. Why is the transaction getting declined? Dagini gets totally confused and embarrassed, and she is very sad, and she returns home to Kutusin and asks him the reason. Kutusin is in a shock and he slowly explains the concept of cash flows and profits to Dagini. He tells, Dagini, I had a book profit of 5 lakh, but these are not all cash transactions. I have both cash and credit transactions, and it just reflects the profit of the year in my profit and loss statement and not the cash that I have in hand. So this is an issue that many of the organizations have to face if they don't have a separate statement that shows what is the true level of cash balance that they have in hand. Now you might be thinking that there is cash book, bank book and all those, but again we need a dedicated statement to show cash inflows and cash outflows, and for that reason we have the cash flow statement, that is Accounting Standard 3 of your first paper accounting CA intermediate, and this is going to be our topic of discussion today. Let's quickly go through our learning objectives. Firstly, we'll have to identify what is a cash flow statement and why it is used. Then we'll look briefly into the 3 different parts of cash flow statement. Firstly, the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. Also, we'll look a little more deeper into the first part, that is cash flow from operating activities, and the 2 different methods for deriving the cash flow from operating activities, that is the direct method and the indirect method. Let's start. Cash flow statement is nothing but a statement that shows all the cash inflows and all the cash outflows, and that will show the current cash balance that we have, that we really have. And this does not take into account the credit transactions that an organization might have. So this is very important in any organization, since they have to be aware of the funding they have in hand, about the liquidity they have. And for this purpose, cash flow statement has been made mandatory for many companies, and it's also very good if every firms can voluntarily make or prepare these cash flow statements. Now we'll look into Kutusin's transactions more deeply to understand the effect of cash flow statement and profit and loss statement. Please remember, this is a hypothetical example, and here we are assuming that he only has 2 types of transactions, sales and purchases. We are assuming Kutusin's sales to be 10 lakhs, out of which 5 lakhs are for credit and 5 lakhs are for cash. Now again, we are assuming his purchases are worth 5 lakh, and there 3 lakh is for credit and 2 lakh is for cash. Now if you come into the profit and loss statement, we will see that his profit would be reflected as 5 lakh, which is 10 lakh minus 5 lakh, which would be 5 lakh. But if you look into the cash cash transactions only, you can see that there is a 5 lakh worth of cash sales and a 2 lakh worth of cash purchases. In effect, he will have a cash balance of 3 lakh only, and this effect is shown in the cash flow statement, and that will help us make better decisions considering the cash balance that we have. So putting all these together, cash flow statement is nothing but a statement that shows all the cash inflows and all the cash outflows. So there is not going to be any kind of credit transactions or non-cash transactions. For example, if we have credit sales, that will not come in the cash flow statement. If we have depreciation, which is a non-cash expense, that will also not come in the cash flow statement. So this is how cash flow statement is going to be, and this is a very interesting topic if you get the logics right. Now coming to the format of a cash flow statement. Cash flow statement is bifurcated mainly into 3 parts. First, we have the cash flows from operating activities, then we have the cash flows from investing activities, and then we have cash flows from financing activities. As the names suggest, this is very simple to identify if you get what each of these headings mean. Firstly, we'll start from the third category, that is cash flow from financing activities. Cash flow from financing activities shows all the cash inflows and outflows that are related to financing. That means raising long-term funds. For example, if you are issuing debentures, if you are borrowing some long-term loans, if you are issuing shares, all these are for the purpose of raising long-term capital. And these transactions, accompanied with all the transactions related to raising funds, will come under the head of financing activities. Again, a confusion might come if you are giving dividends to the shares issued. This is related to the financing, so it will definitely come under the financing activity category, that is the third category, cash flow from financing activities. Now coming to the second category, that is cash flow from investing activities. We have raised funds from cash flow from financing activities. Now we need to have these funds properly utilized, and the major utilization of these long-term funds is definitely investing in long-term assets. For example, we are purchasing plant, we are purchasing machinery, or we might invest our surplus funds in another company. All these transactions related to investment will come under the second category, that is cash flow from investing activities. For example, we have sale of assets, purchase of assets. All these inflows and outflows that are related to long-term investment will come under the investing category, that is cash flow from investments. And finally, coming to the first and the most important category, that is cash flow from operations. Again, as the name suggests, it is basically dealing with all the cash inflows and cash outflows that are related to operations, the normal day-to-day business of the enterprise. Now, if you have to get an example, we can say sales, purchases, salaries, wages, rents, all these transactions that are related for the business to keep running for its operations. Those will come under the category cash flow from operating activities. After categorizing all the cash inflows and outflows into these 3 categories, we will come up with a balance for all these categories. These can be inflows or outflows. So we will have a cash flow, a net cash inflow or outflow from operating activities, one from the investing activities and one from the financing activities as well. Then we'll add all these 3 together and we'll have a net cash inflow or net cash outflow. To that, firstly, we will add cash and bank balances, which are the opening balances for the present year, for the financial year for which we are preparing the cash flow statement. The opening cash balance and the opening bank balance will be added to the net cash inflow or net cash outflow. Then we'll also add cash equivalents. As the name suggests, cash equivalents are something that are equivalent to cash. That means they are highly liquid assets, current assets. These can be readily converted into cash. For example, marketable securities, certain short-term investments. These are considered highly liquid and these can be readily converted to cash. These should also be added to the cash balances that we have come up with. Then we will finally get the closing cash balance or the closing cash and cash equivalents. And this is how we are preparing the cash flow statement. Coming to operating activities a little more deeper. First, we have the direct method of deriving the cash flow from operating activities. When do we use the direct method? The direct method, as the name suggests, is used when we have all the cash inflows and all the cash outflows related to operating activities directly given. For example, we are given with the cash book with all the transactions. It is easier, and in this method we'll have to take all the cash inflows and reduce all the cash outflows, and then we'll come up with the net cash inflow or the net cash outflow using the direct method. This is a very simple example of a cash flow statement using the direct method. As you can see, the inflows such as cash received from sale of goods, cash received from trade receivables, all these are added and all the outflows are deducted to directly arrive at the net cash inflow from operating activities. Before we jump directly into the format of the cash flow from operating activities through indirect method, we can quickly go through the statement of profit and loss from a different angle. Let's start. As you can see, first we have sales. Sales is the revenue that we have, and from that we will reduce the cost of goods sold. What is cost of goods sold? That is the opening stock plus purchases plus all direct expenses minus closing stock, and then we'll arrive at this figure called gross profit, which I believe all of you must be aware of. Then after arriving at the gross profit, we do have several other operating expenses that are crucial to the operations. For example, we have rent, we have salary, we have wages, all those which are not direct but can be indirect as well, but related to operations of the business. These has to be reduced, and if there are any operating income, these can be added to, and then we'll arrive at this figure which is called as the operating profit. From the operating profit, now we are going to do the treatment for non-operating expenses and non-operating incomes. Now, what are non-operating expenses and non-operating incomes? These are simply not necessary for the operations. For example, if we are receiving dividend from another company, if we are paying bank charges, these are not necessary for operations, but these are related to investment or financing or any others. So these expenses has to be reduced, and if there are any non-operating incomes, that has to be added, and then we'll arrive at this figure called net profit before tax and extraordinary items. Now this figure is very important. This is where we'll be starting our indirect method of finding out cash flow from operating activities. Quickly looking, what happens after we derive the net profit before tax and extraordinary items? We'll do the adjustments for extraordinary items if there are any. Like, what are extraordinary items? Those are not at all related to the ordinary course of business. For example, there is a loss due to fire, if there is an earthquake, or if we get some insurance claim. These are not normal, these are not ordinary. These extraordinary expenses or incomes have to be treated, and then we'll arrive at this figure called profit before tax, net profit before tax. And from that we'll reduce the provision for tax, and we'll arrive at this figure called profit after tax or net profit after tax. Profit after tax or net profit after tax. This is the amount that is remaining with the company or the firm or the business after all their expenses, after their tax and everything is met. So what they do is they can have different treatments for this amount. Some people may retain certain amount from this and transfer it to general reserve, or they may even choose to retain it in the profit and loss account itself. Or these companies might also propose dividend out of this amount. So there are various treatments for this amount, that is the profit after tax, but we will be focusing on three different treatments, that is transferring to normal reserves, general reserves, or any kinds of reserves. They can even retain it in the profit and loss account for the next year, or they might even propose dividend. This is how the entire flow of profit goes. Now we'll be coming back for cash flow from operating activities through the indirect method. We have gone through the flow of statement of profit and loss. It's not exactly in the clear format, but this is how the transactions take place, and this is how we derive the profit. For the indirect method of cash flow from operating activities, we need to start from the net profit before tax and extraordinary items. If we are lucky enough, we'll be given with this amount directly. But in some cases, we don't have that. So we'll need to start from the bottom. we'll first have to look whether there is any transfer to profit and loss account in this year. So how will we find that out? We can find the difference between the closing balance and the opening balance of profit and loss account. That's the first thing. Secondly, we can look for any transfer to reserves, and if there are any, that should be added back. Then we can also check for proposed dividend. Again, add that three together and we will get the figure that is the profit after tax. Now, if in the current year they have made any provision for tax, add that back as well, and then we'll get the figure that is the net profit before tax. And usually this is the figure that we need, but in case the company or the firm or the business has some extraordinary items, extraordinary transactions, that has to be also reversed. For example, if there were any extraordinary expenses, we'll have to add that back, and if there were any extraordinary incomes, we'll have to reduce it. Then we'll arrive at our important figure, that is net profit before tax and extraordinary items. This is where we'll be starting from. After we have net profit before tax and extraordinary items, firstly, we are going to eliminate all non-cash and non-operating expenses or incomes. Why non-cash and non-operating? Firstly, why non-cash? This is a cash flow statement, and if there is an effect of any non-cash transactions in this profit, do we need that? No. We'll have to eliminate them. So if there are any non-cash expenses, we'll have to add it back. Any non-cash incomes, we'll have to reduce. For example, if depreciation is given, that has reduced the profit. We'll need to reverse it back. So we'll add depreciation back. Similarly, we'll have to look for non-operating expenses, those that are not related to operations. For example, debenture interest paid, bank charges, dividend received. All these are not related to operations. These are related to financing or investing, and these will go in that category. So those expenses has to be added back, and those income has to be reduced. And then we'll arrive at this figure, which is called the operating profit before working capital changes. Now we'll have to look for the changes in the working capital. Why are we doing that? We have arrived at a figure that is operating profit before working capital changes. But there, if you closely observe, we have sales, purchases, all these are not completely in cash. There might be credit transactions as well. But if you look into the profit and loss statement, you cannot see the divisions as to how much is cash, how much is credit. So for that reason, we'll go to the balance sheet and we'll check all the current assets and current liabilities except cash in bank. And then we'll observe the changes. For example, I am taking debtors. Debtors has increased by 1 lakh from the past year to the present year. What does it indicate? That means there has been some sort of credit sales. So this amount has to be reduced from where? From our profit that we have arrived at. So for all the working capital changes, we have to bring in effect. How will we do that? If there is an increase in the current asset, we'll have to reduce. And if there is a decrease in the current liability, we'll have to reduce. It might be confusing, but I'll give you a shortcut. Add ADLI, ADLI. That means if assets decrease or liabilities increase, add that. And reverse it. If assets increase and liabilities decrease, reduce. Now you can take some time and think how this works. You can also take the example of the debtors and then think this is how we are going to give the effect for working capital changes. Now we have this figure called cash flow from operations, but that's not it. If we have actually paid some tax, for example income tax, now we have to reduce this. Now you might be confused, we had a tax in the beginning. That is provision for tax. This is the actual tax that we have paid. This has to be reduced from the amount that we have come up with. Again, if there is an actual payment or receipt of any extraordinary items, these has to be treated here as well. And after both these adjustments, we'll finally arrive at the net cash inflow or outflow from operations. And this is all about the indirect method of cash flow from operating activities. While we do the questions, we should have these concepts in our mind, and solving questions would be very easy. One of the biggest confusions that we have is definitely as to the treatment of tax. Please remember, cash flow statement only looks at what is actually paid. So if we are reducing the amount, that must be actually paid. And if we have already reduced some kind of provisions that is not actually paid, please reverse it. So for getting a better understanding of the treatment of tax, we should definitely draw the ledger for tax. We should see what is charged to profit and loss and what is actually paid, and the amount that is actually paid will give an effect to the cash flow statement, not the one that is charged to the profit and loss. If it is charged, please reverse it, and the amount that is actually paid has to be reduced at the end. Quickly revising, we have two methods of cash flow from operating activities. First is the direct method. Direct method is when all the cash inflows and outflows related to operations are directly given. For example, if we are given with a cash book, we can identify which all are related to operations, and then we'll add all the cash inflows, we'll reduce all the cash outflows, and then we'll finally arrive at the net cash inflow or outflow. It is that simple. But when we come to the indirect method, this is used when we are not directly given with all the cash transactions. What will we do? At that point, we'll be looking at the net profit before tax and extraordinary items. We will do all the adjustment for non-cash and non-operating expenses. If those are expenses, add back. If those are incomes, reduce it. Then we'll arrive at the operating profit before working capital changes, and from that we'll make the adjustments for all the working capital differences. We'll add ADLI. If assets decrease or liability increase, we'll add it. And please remember, these are current assets and current liabilities. And if assets increase and liabilities decrease, we'll reduce. These does not include cash and bank balances, please remember. Then we'll arrive at this cash balance, and then we'll have to add or reduce for any effects of tax actually paid or any refund received. And if we do have some extraordinary items, the effect of that which has actually been paid or received has to be also done for, and then we'll finally arrive at the net cash inflow or outflow from operating activities. That's it. Please take a screenshot of both these formats and kindly go through the concepts. And from the next session, we'll be starting to solve the problems, after which I believe and assure that all the concepts will be clear to you. We have come to the end of this session, and I believe and hope that you might have got at least a small idea about the cash flow statement, the different parts included in the cash flow statement, that is the operating, investing and financing activities. And also we had looked through the operating activities a little more deeper, the two different methods, and I believe you might have had at least some good learning from this session. Thank you so much for your time. Let's meet in the next session.